Today we're going to be talking about asymmetrical risk reward. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Wednesday, middle of the week. We've had 2 days this week with some very big moves. Perfect trade yesterday on the pound. A great reversal trade on the pound Aussie as well. We're going to talk about a couple things that have come up. We're going to review our simple system, and we're going to talk about asymmetrical risk reward mainly. We're going to talk and review the timings, why I specifically like to focus on that 3-hour window. A few questions came up yesterday. We're going to review that. We're going to talk about gap time trades, pros and cons, and which ones I will take, measured moves, and then live time decision making. So asymmetrical risk reward. When I first got into trading, I always talked about, well, yeah, I want to try and make 5 times or 10 times what I'm risking on a trade. But I actually didn't have a practical method that melded with what was happening on the chart with reality. So meaning that although I would get into the market in a trade and I'd want to get 5 times in my risk, I actually didn't understand what that meant in a technical perspective in terms of an applicable model where I was actually targeting asymmetrical risk reward based on the setup of the trade. Now, you've heard me talk about price is always in a box. We talk about buying low and selling high. I know that a lot of traders are finally seeing this crystal clear, and in fact, some are hitting better trades than I am. And the important thing to understand about that, when we talk about price being in a box, if we have a high and a low, it can be a session high and low, it can be a daily high and low, it can be a weekly high and low. Some weeks we will trade from low to high and high to low each day. Other trade setups will be specifically from a session low to a session high or a session high to a session low. And other trade setups may be from the low of the day to the high of the day. So the important part to understand about asymmetrical risk reward, Peter Brandt taught me this. I read his books. I listened to him talk in his workshops, and I studied his charts. I didn't really quite grasp it though. One day the penny dropped. And I talk about this over and over again. I know some traders have said to me, oh, the 12 candle window doesn't matter, and I'd rather take 10 5-pip trades. What I want to do is I want to get into the market. We talked about this yesterday. We saw a great trade on the British pound. The market came up and it went bang, 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 reversed on the London Open. Second candle, and it just went from there, consolidated and continued. Now, asymmetrical risk reward is when I can take a trade with 1R and I'm targeting maybe 2, 2.5, 3, maybe 5, maybe 10 times my risk. We're going to look at an example yesterday on both of these pairs. Some traders have asked me about my screen setup and using other time frames. I use the 15-minute charts to identify my highs and lows and the stop hunt. So traders have gone long at the beginning of the session or from the previous night's close. They've gone up to the round numbers, maybe 25 or 50 pips. They've gone into consolidation, they've pulled it back. Traders are looking, again, remember the psychology behind all of this. When the market moves up 25 to 50 pips, guess what that does to all of your indicators? That shows the trend, your EMAs, all that stuff, that shows the trend is up. And traders are looking to catch that swing back with the trend. But the 12 candle window and the importance of timings, we see that first hour come down to the low of the day and on the London Open reverse. That completely flies in the face of what seems rational to any individual. The trend is now going down in their eyes. It gets to the low of the day at the specific timing. They bring the market down for the equities hour of London to open up down low. Now we have 2 scenarios. We have a profit target at the high of the day, the round numbers, and again, it's all about how price behaves. This market exploded up here in that first hour, couple bars sideways, and continued the move. Now, if this is a 25 pip box, I've talked about measured moves. I take this box and I expand it by 2. So now we're targeting at least 50 pips if you've bought down here. The market could stop there. That could be double zeros. It might pull back because now timing wise we're getting to the end of that 3-hour gap time window, and maybe they're going to pull it back and continue that move in the US session. Or it could explode as we saw in the pound Oz, and then on the next 25 pip box up here start to pull back into consolidation. So that market now has gone 75 pips from low to high. Pound Aussie did 100. If you get in on a smaller time frame, we're going to look at an example of a 3 push pattern on the 1 minute right at the London Open. You're looking at about 15 pips depending on how tight your entry is. But if that market explodes, you're in virtually a zero heat stress trade. Now, I'm not suggesting to go to smaller time frames, because a lot of traders will start taking trades on the shorter time frames all over the place, and they'll miss the bigger perspective of the high and the low, and then the move to the high or to the low, and then the reversal or the breakout pullback continuation. So we see the market come down, we see the reversal. Now we're targeting maybe 3R. So we're risking 1R for 3R, maybe more, maybe 6R. So you can get stopped out on a 1R trade, and we're not even talking about loss aversion. We'll get into that in another video, where traders just refuse to take a loss, or they don't like to use stops for whatever reason. But you can recover. You can take a 1R loss if your average win is 2.5 or 3R. So you can have 3 trades in a row of a loss, and one winner completely brings you back to even, and you might have 3 more winners, and now you're up 9R to your 3R loss. So again, when we have our box, if this is our box, it could be 50 pips, it might be here. If that's the high of the day and that's the low of the day, the market goes up and it might be working the high in Asia, and then in London gives a 1, 2, 3 for a fast move down, because when they go fast, it's because they have traders trapped either up high. So like yesterday, they had volume trapped up high, so they move fast down to the lower 25 pip box. Or they're going to stop out traders who have not taken money off the table. And so the other side of the coin is that when a market is moving that fast to the low, that scares traders out of wanting to enter into the market to go the other way. And then they painfully watch the market pull away, another bar, and another bar. Now it's too late because you're chasing the trade, and they go another bar, and then bang, it's gone. And on the ones that you do chase, it's probably the one that comes back and does a second tap and hits you for a W or a measured move in the other direction. Paul Tudor Jones talks about taking a trade and then realizing he's caught in a measured move and he can't get out. They close the market and it opens up the next day, limit down. And that happened 3 days in a row. It almost completely wiped him out. This was in his early days as a trader. It almost completely destroyed his trading account before he was able to manage to get out of the trade. But he also talks about not looking at anything that doesn't give him at least 5-to-1 risk reward. So again, studying Peter Brandt. Peter Brandt's a classical chartist. And like Peter, I don't like to trade on trendline breaks or anything else. I will look for a trendline break as a first sign of weakness if we're getting near the high of a session or a low of a session after a big move. But I purely like to look at horizontal rectangular breakouts. I think they're easier to identify. They're easier for me to target asymmetrical risk reward with measured moves. If you want to read more of Peter's books, the links are down below. Peter's been around for 40 plus years trading. He's pretty much seen it all. He's a hard-nosed, old school chartist, but I learned a ton from Peter just about asymmetrical risk reward. The one thing he said to me is that when these trades break out, he's purely a breakout trader. When they complete a pattern and he enters that market, the thesis is that that market has coiled volume, and he likes to look at 8, 12, 16 week patterns, weekly and monthly charts. When that market breaks out, his thesis is that that's his 1 bar stop, and when these are coiled and they're going to explode, they're going to go at least 1 full expansion on a monthly or a weekly chart very, very quickly. So he's in and out of those markets maybe 3-4 weeks, maybe longer sometimes, because we can get, again, a second range expansion. he talks about 3 or 4 big trades a year making the bulk of all of his money. Now, you've been following me long enough to know that when these markets coil and they do a stop hunt, they're over in 1 hour and they go 50, 75, sometimes 100 pips in an hour. So yesterday's a great example. 30 minutes down, 45 minutes down, a couple hours up and there's 100 pips, not even that. So again, I've specifically narrowed my window down to the 3 pound USD, pound Oz, and gold, 15-minute charts. I still look at pound yen, pound Canadian, pound Swiss for their general chart pattern each day to see if anything there is attractive in terms of high of the week, low of the week, and the pattern itself. Last week they had some great trades. But generally speaking, gold has been responsible for the bulk of my trades in the last month, and the pound. I mean, I'm not trying to trade every move. I'm looking for one trade setup, usually per session. These markets all move 50 pips each at least once a day. Gold in particular seems to be giving off 50 pips almost every session. Today's a little bit quieter. Still 50 from high to low, but maybe not tradable. So just to review the timings. So I saw a few people were discussing the timings yesterday, different regions, about the equity markets and everything. Let me make something very clear about these 3-hour windows. I've talked to different traders. I've studied them for years now. Every single day I watch all 3 sessions and I watch exactly what happens. I don't care what time the equity markets open in your region or anything else. These 3-hour windows are exactly 90% of the time when you will see the algorithms come to life and start to do their work. So there might be other trades that happen. They might move earlier. They might move a little bit later in the gap time after they've coiled volume. Understand what's happening in that 3-hour window. The algos are doing their job. They're going to work. They're going to either cluster volume for a big coiled explosive move maybe later in the gap time or at the end of that window, or they've already built a box in that pre-market and now they're going to do either a move from low to high, high to low, or a range expansion move of 25, 50, maybe 100 pips. So you can trade any times you want. I'm just giving you my reasons why. I know for 90% of my trade setups, they happen inside of this window. I don't care. And I want to be able to duplicate that myself each and every day, because then I can reproduce my results. I'm looking for, again, some of the traders emailed me their screenshots and they said to me, this is the same trade that was on Monday, this is the same trade that we saw last week, and the same trade from the week before. Now you're starting to build a playbook of your best trade setups. 1, 2, 3, engulfment, pin, hammer, 50 pips. It's that simple. Let them go to the high or to the low, look at your charts, see where the highs and lows are. Look who's in the money. Is volume trapped up high? Is it trapped down low? Did they, like we saw in the pound Aussie on Monday, breakout pullback? Somebody asked me, I thought you didn't trade in the gap time. I didn't trade that, but it was a breakout pullback and a continuation in the US session after a 25 pip stop hunt into the quarter level. So it's just about the 3 things markets do. They break out, they pull back, and they trend. They break out, they pull back, and they reverse. False break reversal. They break out, they pull back, and they go into a trading range. But specifically in these timing windows, I'm looking for a stop hunt to the high or to the low. If it's inside of the range, those are the easiest ones to see, especially if the market has moved 50 or more pips. And then I'm looking for, are we at major round numbers? Are we a quarter level above double zeros, or a quarter level below double zeros or 50? Because they may be trapping volume outside of that 50 pip box for the fast move back the other way. We saw that on gold last night. For the gap time, they worked it inside a quarter level below double zeros. In the beginning of the US 12 candle window, they hit the double zeros, they brought it back down to 75, and then bang, they went 50 pips to the high of the day, only by about 5 or 6 pips, consolidated and reversed and did the popcorn trade and went straight back down 50 pips. They worked it, dropped it over towards the end of the session, another 50 plus, pulled it back, and they're still down there now. So that's 100 pips from yesterday's high. 1 bar stop, asymmetrical risk reward. So keep thinking box. I want to sell something here and I want to buy it down here. That's the risk reward. And again, I'm not talking about a trend trade where the market is broken out and it's continuing. I'm not saying jump in front of a trend. How do we know? Timings. Timings. If you want to trade Tokyo an hour earlier, don't be surprised if when that 8 o'clock window shows up for Asia, that they don't come back with one little wick on a 1 minute candle and just pip you out. Or even hit it one more time to stop out traders. So we don't know what they're going to do, but I wait because I know when that window kicks in, that's when the algos are going to work. So gap time trades. If they do a 3 push pattern over 3 hours and it's a squeeze up high or down low, I am going to trade that. I will trade it because if they've moved it up and it's a 25 pip candle or something right at the open and they're working it into an upper 50 pip box and over 3 hours it doesn't go anywhere, what does that tell you? 1 push, 2 push, 3 pushes, and maybe a 33. Now we're talking about maybe 75, 100 pips in the other direction. And when it comes out of there, it's going to move fast and hard. Measured moves, we talked about that. So again, just to come back about live time decision making. Live time decision making. You make a trade in live time, you make a plan, you prepare, you get your levels, you've got your pairs. The market you get a couple scenarios. Maybe I'm thinking long, they're going to maybe take it up high first and then stop hunt low before they continue the trend. Maybe they're going to break out, pull back and continue. Maybe they're going to stop hunt low, pull it back and do a move in the opposite direction. It doesn't matter, but when they do it and I make a decision, number one, I want to control my risk. Okay? You don't want to get caught into whipsawed, get beat up or get angry, get frustrated. You got to be talking to yourself. You got to have a clear mind. And I also have this 2-hour rule with myself. Unless it's a coil, I want to be done hopefully in that first 2-hour window. So I'm always looking for the best or easiest setup that I can see. If it doesn't pan out, I know there's going to be 50 pips in the next session. But if I get in, the market moves 25, goes consolidation, comes back and hits my break-even stop, and then I'm into the 3rd hour and I didn't take 25 because I thought it was going 50 or whatever. So what? You make decisions, you learn from those decisions. Sometimes you're going to take 50. I talked to David yesterday. I've done this a ton of times. The market went down, pound Aussie, came back up, 50 pips, but then it continued for a measured move. Master getting the 50 pips. Don't worry about the second 50 or the second 100. Learn from those. Figure out how you could get more out of the winning trade. Which pairs, which setups are going to give you that presumption beforehand that maybe this could be a measured move. So day 2, level 2, or day 2 down low. Maybe it's going to be a trend day. We don't know. Maybe it's going to go 50 and you're going to hold on and it's going to consolidate and reverse and you're going to get 30. So sometimes those are tough decisions to make. Some traders like to use multiple lots. I typically enter into a trade with one size and I exit on one size. Maybe I need to change that. But you learn in each trade. It's a game of constant progress. Trading mastery is a never-ending destination. The market will continue to throw stuff at us. It'll continue to lure you into trades that look good and you get beat up. But number one, control your risk. Focus on asymmetrical risk reward. Then you can keep growing your account. You can keep growing your confidence and your skill set. You know, it's easier and easier. The longer you do this, the more you get beat up. If you don't blow out your account, you're going to start to see how many times these false moves happen that you've been caught in before, that now you're watching them saying, oh, this is the trap, and bang, the next candle reverses and keeps going in the direction of your trade. You're not going to get every single trade right. It doesn't matter. Focus on mastering each and every trade that you're in. Focus on talking to yourself and staying tuned into the process. Control your risk. Like Paul Tudor Jones says, play great defense. If he has positions going against him, he cuts them. Peter Brandt, if he has a trade going into a Friday night that's negative, into the close, he cuts the trade. He will not hold anything over the weekend. I know within 10 to 15 minutes if I'm in the right trade or not, because usually they respond very quickly. They might come back and work into me But usually when you're in the right trade, bang, there's a response. And they don't typically hang around if you've waited for the timings and you're at the high and the low. If you're blindly jumping in, the next candle could bang, hit against you, and you're underwater. So I don't hold on. Anything that goes against me, usually, typically, if it's not working right off the bat, I get a very, very strong sense of awareness about that trade is possibly not right, or I've gotten in too early, or I got caught into something. I cut the trade because I know, again, I can recover from 10, 12, 15 pip loss, even if it doesn't hit my stop. I can get over that, and I can get that back fast, especially when you're targeting 50, 75, or 100 pips on a trade. So focus on asymmetrical risk reward. That's the whole point. And if you're really studying these charts, you'll see this clear as a bell. Get all the stuff off your charts. Get all the indicators off. Take the numbers off. Take everything off. And just watch what happens over the course of the day. And some days on a trend day, there's usually a trend day once a week. And that usually starts and forms a low, peak formation, or a high, peak formation. And then bang, it never comes back. Well, that's a trend day. But when they go up and make a high, and they pull it back and they work it again, now you're in a box. You got a high and a low. And when they make higher lows, they're trapping volume up high, or they're trapping volume down low, which is why when we get that W at the end of the equities hour or the third hour for the squeeze, that's why it's a big explosive candle, because now, boom, one candle, they lock in about 3 hours of volume that's caught now. If you look at the closing price, usually it'll trap 10, 12 candles at least underwater that are now in negative, that were following the trend as it was creeping down or up. So hopefully you got some value out of today's video, traders. Tons of great feedback. Jacob in the UK nailed the pound yesterday. David got the pound Aussie. I know Carr's had some great trades, and thank you for the questions, Carr. I appreciate all of that. And keep it going, traders. It's a winnable game. It's a game of constant progress. It's the hardest way to make easy money. This is about playing with the big boys and getting better and better every single day. Number one, don't blow out your account. Focus on constant progress. You can win this game. Have a great trading session. We'll look at a couple of examples from yesterday. Have a great day, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading, continuing our discussion on asymmetrical risk reward. Yesterday on the pound, we saw a great example of early in the day setting a high of the day in place. They also had a low of the day in place. Asia made a higher low in our 3-hour 12-candle window. At the beginning of the Europe-London 12-candle window, we saw the false move towards the high of the Asian range inside of the high of the day. So again, trapping volume inside of the peak formations, going sideways in consolidation, false move, getting traders to chase that fast, impulsive move towards the high, perceiving this as a trend trade. They chase the move and immediately the market comes back. So again, in that first hour, trap, stop hunt. So again, stop hunting traders that are short in the creeping trend down. They're in this market for 3 hours and it hasn't even gone 25 pips. Bang, they hit the high and immediately inside bar, and they go 1, 2, 3, stopping out traders that are long from earlier in the session. And again, I mentioned just looking at all the volume above in the upper portion of this 25 pip box. They come down to the round numbers at the end of the first hour as we head into the equity hour. This 2-bar reversal is a reversal into the equities hour. 2-bar reversal after the 1, 2, 3, hitting stops, hitting the breakout traders who are in possibly early in the rollover when the spreads tighten, whatever, or in from the previous night's close. That market immediately pulls back, moves quickly in 1 hour back towards the high into consolidation and continues for a measured move. Now again, traders taking this trade don't necessarily know if we're going to get a measured move or not. But as time progresses and we get towards the next 12-candle window and the market is creeping back down, we've hit a high of the week. This market has moved 3 25-pip boxes pinned up into the just below the 75. So again, an area where as we go into the next 12-candle window, if this has not hit your profit target, or if you're going for more than 50 pips, as we get closer and we get the high bull, I would be comfortable trailing this trade on the high bull candles as we get close in towards that last hour before the 12 candle window. Obviously, that is the most likely time frame for the market to come back and correct into the trend. But again, we also had a move of greater than 50 pips. Point being, though, this textbook setup, peak formation early in the session, they go into consolidation in the Asian range. They set a higher low and a lower high inside. False move towards the high of the day before 1, 2, 3 breaking out of the consolidation. So the stop hunt is down into the low of the day for the reversal at the beginning of the equities hour. This is a trade setup that obviously, if several traders commented, this is textbook. This shows up again and again and again. Stop hunt low, and then the move back in the intended direction. And just again pointing out asymmetrical risk reward. We have a high of the day and a low of the day. We're in a 25 pip box. We're targeting a 1 bar stop and at least 2-3 times our risk just back to the high of the day. But again, if we're targeting 50 pips, the entry on this trade, close of this candle, if you're filled around 05, 06, even if you take the low of the day as your maximum stop, you're looking at 14, 15 pips. So again, that's 3R minimum. If you targeted more than 50 pips, if you trailed this market, if you got 60 pips, whatever, now we're talking 4R on your trade. But point being, risk reward, we have a box, we have a 1 bar stop, and we're targeting 2 to 3 or 4 times our risk on this particular trade. If we're wrong, we're stopped out. It's a 1 bar stop. We can recover from a 1 bar stop. The important thing is to always manage our risk. Gold, we had 2 peak formations. We had one from the previous night before on the stop hunt through to the low of the week, and then the peak formation in the Asian session, in the U.S. session, and then we headed into the next day. The market had a low and a high heading into the day inside of the peak formations. The market went to the high of the day, 1, 2, 3, at the end of the 12 candle window for a 50 pip stop hunt back down to the low of the day. They pulled it back inside, and the stop hunt was down towards the low of the day. So again, we have a low of the day in place. We have a high of the day in place. The first move was down inside, nothing to the extremes. We're inside in that first hour. Just tighten this up. And then the equity hour, the London first candle of London, opens up and pins down to the low before pulling back. Again, we're inside. Again, we talk about lower highs or higher lows inside of a range are getting traders to short this market inside in the lower half of this 50 pip box. 1, 2, 3 to the high. They hit the high, inside bar, consolidation, a pin doji inside of the high of the day, above the round numbers in the upper quarter for a 25 pip stop hunt back down. So again, an example is that if you had shorted this market on the 15-minute and we get 1 push, 2 pushes, and then a 3 push down as we head into the 12 candle window. So again, another example of where the market has been for 3 hours inside of a 25 pip box, not going any lower. We ask ourselves the question, where is this market trying to go, and how good of a job is it doing at doing that? So 3 pushes, and then we're into the 12 candle window. We get a 1, 2, 3 to the high, again to the high of the day, hit the stops, an engulfment, 2 pins down, fooling traders, again scaring them out of the short position, pulling back before we get our continuation down. So again, traders, you may short this market, and you've shorted this and you're thinking, well, this is a 40 pip candle. And as I mentioned before, we fight for a better fill price. These pins are in the middle, would scare traders out of staying in that position. The market goes sideways in consolidation for 4 bars for an hour before dropping down and engulfing again, forcing traders to chase the move now halfway through the move. But again, I mentioned before, when you get the large candle and you have an engulfment that comes down and you have an opportunity to fight for a better price, even when we have a large candle, very rarely when it is at the right trade do they come back further than 20 pips, which is why even if this was a 35 pip candle or whatever that may be, my maximum stop, especially if I get filled at or right near the numbers, is going to be 20 pips roughly in that area, because I know that if it goes back through that level, then it's definitely not the right trade. When these are right, even when they stay in consolidation, that's part of the manipulation tactics, scaring traders out of a trade that is in a winning position. Again, my maximum stop, I'm in the market. I've accepted that I can lose on this trade. It's 20 pips. I'm not going to get when I make this decision, in my mind, I'm always telling myself, I sold at the high of the day. I've sold at the high of the day. So regardless of what they do, I need to let that trade play out. I sold at the high of the day. So let the trade play to fruition. This is a situation where sometimes you need to walk away from the screen. You've got your stop in place. You've got your target in place. You walk away. There might be a time decay factor. The market's moved down. You've moved to break even after the second engulfment. And that's, the decision you make in live time. If after a couple of hours the market has moved down but not hit your 50 pips and you want to hold on to it for more, or maybe it has hit your 50 depending on your fill price, those are decisions you can make. You can cover the trade, go to break even, whatever that is. But once I'm in the market, if I've sold high or bought low, sometimes you need to let that trade play out. And again, we're in a sideways range-bound market, an example again of a market that's broken out, pulled back, and gone into consolidation over a full day. It's a narrow range day. Possibility we may have a large ranging day today that breaks either down or back up towards the high of the week. Again, similar example on the pound Aussie to the pound. We saw this market move up 50 pips before the Asian session began. We have a high of the day in place. We have a low of the Asian session. We had higher lows heading into the 12 candle window, as well as the lows of the day and of the pre-market. But a good example of where they took the extra hour before they dropped it down to do a stop hunt in 2 bars, 50 pips, inside bar, then a bullpen hammer on top of the inside bar. Timings again at the end of the 3-hour window. Just an example also of where traders can enter this market. They target 50 pips, but understanding also when the market hits its 50 pip target, we're now in a breakout market. And sometimes these are hard. As I mentioned in the first half of the video, we make a decision in live time, and you get your 50 pips. It might go 100, it might go 150. Those are just decisions we make. We learn from every single trade. Low of the week, high of the week. Those are the greatest possibilities when we get structure and geometry for measured moves for them to play out, especially when the market comes down fast and aggressive to the bottom or to the top of the range for the day and they reverse it. Those are the markets that have the highest possibility of continuing for a range expansion. And again, it's all about how price behaves when they get to the highs and lows. This market traps traders shorting this market. And the important part about this is understanding the timing window. They've already done a stop hunt down. They've done a stop hunt to the low of the day. They've broke to the high. They've hit the stops. They've pulled it back. Sometimes it's a matter of making a decision and giving it that extra few bars to watch how price behaves and then allowing that market to continue possibly for the full expansion of the range. So keep it simple, traders. We learn from every single trade. Again, asymmetrical risk reward. Price is always forming a box. They're either working the high. This is a great example as the pound was. They put a high in place. They worked the high. They worked the high. They went into consolidation. They head into the next 12 candle window. 1 push, 2 push, 3 pushes, sideways at the numbers. 50 pip stop onto the low of the day. Inside bar, bullpen hammer for the fast 100 pip move back up through the high of the day. Have a great trading session, traders. Stay disciplined, stay focused. Keep it simple, keep getting better, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.